48 hours ago, a seismic shift rippled through the global financial landscape, one that most investors remain blissfully unaware of. Yet, for those who delve into the murky depths of dark liquidity metrics, the implications are staggering. In just one trading session, a jaw-dropping $1.4 trillion evaporated from the S&P 500, not due to a typical sell-off, but as a result of a systemic liquidity freeze that has effectively paralyzed the repo markets. This isn't merely a market correction. It's a catastrophic failure of the very infrastructure that underpins global commerce. As we dissect the forensic data revealing why tomorrow could signal the onset of an irreversible collapse, we find ourselves staring down the barrel of a financial apocalypse. The futures markets are already forecasting a catastrophic 700-point drop in the Dow, driven by an unprecedented spike in the volatility index. The stark mathematical reality of 2026 is that the U.S. national debt has reached a staggering $38 trillion, with interest expenses now eclipsing the entire defense budget. This sets in motion a fiscal death spiral, where the Treasury must issue more debt merely to cover the interest on existing obligations. When Michael Burry, the renowned investor who foresaw the 2008 financial crisis, takes a massive short position against the Mag 7 AI bubble, it's not just a bet against technology. It's a wager on the collateral value of the entire financial system. He knows that when the collateral is exposed as over-leveraged, up to 30-1, the resulting margin calls will be nothing short of catastrophic. Institutional investors are already retreating to the sidelines. Berkshire has amassed a record $382 billion in cash, with Warren not waiting for bargains, but instead gearing up for a systemic reset. The current Shiller PE ratio, sitting at a staggering 36, has only been matched twice in history, once in 1929 and again in 2000, both times preceding drawdowns exceeding 50%. Our analysis indicates we are not merely at a peak, we're on the brink of an extinction-level event for the traditional 60-40 investment portfolio. With the reverse repo facility nearly drained, the last safety net for banking liquidity is gone. A sudden spike in demand for dollars could trigger a global credit freeze, reminiscent of the turmoil seen in September 2019. The eurodollar market is exhibiting signs of extreme stress, with basis swaps widening to levels we haven't witnessed since the pandemic. The world is now short on dollars, and the only way to acquire them is to sell off everything that isn't nailed down: gold, Bitcoin, even the once reliable Nvidia stocks. We're witnessing a digital domino effect as algorithmic trading bots, which now command 80% of daily volume, are programmed to sell simultaneously should the VIX breach the 35 threshold. This creates a feedback loop of selling that no human trader can interrupt. When Asian markets open on what's now being dubbed Black Sunday, these algorithms will detect surging credit default swaps on major US banks and trigger a sell-off across the board. This is how a mere flash crash could spiral into a full-blown Great Depression. The AI has been the sole buoy keeping the S&P 500 afloat, yet the revenue-to-capex ratios of these companies are beginning to mirror those seen during the fiber optic bubble of the late 90s. Billions are being poured into hardware, but the anticipated productivity gains are nowhere to be found in the broader GDP. If Nvidia misses its earnings growth projections by even a fraction, the tech sector could face a staggering $5 trillion market cap loss in just a week. Our investigation into the 13F filings reveals that insiders are selling at a staggering 12-1 ratio compared to retail buyers. Meanwhile, inflation has not been tamed. It has merely been postponed through strategic petroleum reserve releases and temporary supply chain fixes. As we approach late January 2026, a commodity is reigniting, with oil prices threatening to surge past $120 per barrel due to geopolitical tensions in the Red Sea and the Straits of Hormuz. High energy prices are acting as a tax on consumers, compounded by 7% mortgage rates, which have finally broken the American consumer. Credit card delinquencies are hitting a 15-year high, surpassing levels seen during the height of the 2008 crisis. The commercial real estate debt bomb is ticking down, with over $2.2 trillion in commercial real estate debt maturing in the next 18 months, most of it financed at 3% but needing to be refinanced at 8%. Major regional banks are now sitting on unrealized losses 3 times their capital buffers. When the first significant office REIT defaults this Sunday, it could spark a bank run in the digital age, where cash moves at the speed of a swipe rather than a line at the teller. Our outlook indicates that contagion is not just possible, it is inevitable. The Federal Reserve finds itself trapped. If they cut rates to save the banks, the dollar will collapse, inviting hyperinflation. If they maintain high rates to combat inflation, the entire banking system could implode. They've chosen the latter for now, but the market is about to force their hand. This Black Sunday marks the moment the market realizes that the Fed's protective measures, the so-called Fed put, are dead. No bailout will come this time, as the Fed's balance sheet is already bloated with $7 trillion in depreciating assets. Every time market valuations disconnect from economic reality, the ensuing mean reversion is always violent. Currently, we sit 40% above the historical mean, suggesting a collapse that could obliterate an entire generation's retirement savings. Our forensic team has pinpointed the trigger for this Sunday: a massive derivative unwind in the Japanese yen carry trade. This trade has quietly served as a liquidity engine for global markets for a decade. As the Bank of Japan raises rates to save the yen, trillions of dollars borrowed cheaply to invest in U.S. tech stocks must be repatriated, inciting a forced liquidation of the world's most popular stocks. When you observe Apple and plummeting 5% in pre-market trading, you're witnessing the carry trade unwinding. What begins as an orderly exit will soon morph into a stampede. The small business sector, often regarded as the backbone of the U.S. economy, is already in a silent recession. The NFIB Small Business Optimism Index has sunk to its lowest level in the survey's history. These businesses are unable to bear the cost of capital and are beginning to lay off workers at an accelerating rate. The unemployment rate is the last lagging indicator to shift, but it's starting to tick upward. Once it breaches 4.5%, the SAM rule will trigger, confirming that we are indeed in a deep recession. This Black Sunday isn't solely about the stock market. It signifies the potential demise of the petrodollar. As Saudi Arabia and BRICS nations pivot towards a multipolar settlement system, the demand for U.S. treasuries as a reserve asset is quickly dissipating. This change means that the U.S. can no longer export its inflation to other countries. Our research indicates that this loss of reserve status could trigger an unprecedented, overnight 30% devaluation of the dollar's purchasing power. Bitcoin and gold have been hitting all-time highs not due to their rise, but because the paper currency they're measured against is declining. They serve as the canaries in the coal mine. When the systemic collapse begins tomorrow, even these safe havens may experience temporary liquidity washouts as traders are forced to liquidate their winning positions to cover margin calls on their losers. We are entering phase 1 of a collapse where correlations converge and everything plummets together. The passive investment trap is the final piece of this grim puzzle. Millions of investors are automatically investing in index funds, which are now 30% concentrated in just 5 stocks. This creates artificial demand on the way up but leads to automatic selling on the way down. When index funds begin to see outflows this Sunday, the market will be flooded with sell-at-any price orders, triggering a waterfall decline that exchanges will have to halt with circuit breakers. Yet halting the market won't resolve insolvency. It merely postpones the inevitable. Our forensic audit of the global credit market shows that high-yield spreads are finally widening, signaling that default risk can no longer be ignored. We have zombie companies that exist solely due to access to 0% interest rates. Now that money is becoming costly, these companies are effectively dead men walking. When credit markets shut down, the stock market will follow suit within 48 hours. That window closes tomorrow. When the opening bell rings at 9:30 a.m. Eastern tomorrow, it will likely represent one of the most critical financial moments of your life. It will mark the end of the easy money era and the dawn of the great deleveraging. Those who are prepared will survive. Those who are all in on the bubble will be wiped out. The collapse is not merely a possibility, it's a mathematical certainty rooted in the exhaustion of credit. We are witnessing a sovereign debt crisis unfold in real time from the UK to Italy to the United States. Governments are reaching the end of their tether. They've exhausted every monetary strategy available and none have worked. The velocity of money is plummeting, meaning every new dollar printed is having a diminishing economic impact. This is the law of diminishing returns applied to a global empire. Black Sunday signifies the day the world loses faith in the magic of central banking. Our analysis of the options market reveals an unprecedented amount of gamma concentrated at strike prices below the current market levels. This means that as the market declines, market makers will be forced to sell more futures to hedge their positions, creating a downward spiral that accelerates. Tomorrow's gamma flip will be the engine of destruction. The retail investor, the last to enter the pool after being assured that stocks only go up for 15 years, is now fully allocated and possesses no cash reserves. This is the epitome of a market top. When panic ensues tomorrow, retail investors will be the last to sell, absorbing the full brunt of a 40% decline. As the sun sets on this Sunday, the global financial order is hanging by a thread. The forensic evidence is irrefutable: record debt, record valuations, record concentration, and record low liquidity. The math simply doesn't compute any longer. This collapse is the system's way of expunging the rot. It's painful but unavoidable. Tomorrow, the weight of contradictions in the market will prove too heavy to bear. Speculation will cease and reality will take hold. Our analysis shows that the market has run out of greater fools. Every buyer has already purchased and now only sellers remain. When the balance shifts so dramatically, prices must plunge to seek liquidity. Tomorrow, that plunge is poised to be the largest in the history of the New York Stock Exchange. We are entering a season of accountability. For 2 decades, we've borrowed from the future, and now that future has come to collect its dues. Our forensic data proves that collateral has vanished, credit is exhausted, and confidence is shattered. Black Sunday is the expiration date of the global debt experiment. Tomorrow, the bill comes due. The market is a complex adaptive system, and it is now adapting to an environment where money is no longer free. This adaptation will result in collapse for those holding paper assets. We are transitioning into a hard asset world where cash flow and tangible value reign supreme. Tomorrow represents the reckoning for the virtual wealth conjured by the Federal Reserve. As futures markets bleed in the waning hours of Sunday, institutional traders are beginning to realize the game has fundamentally changed. The old rules no longer apply. Our forensic report on Black Sunday serves as a final warning for anyone still holding long positions and unhedged. The collapse is upon us. Tomorrow, the opening bell will toll, but for the bull market, it will be a funeral knell. As midnight strikes on this Black Sunday, the illusion of a stable global financial system will dissolve, revealing a $4,500 trillion derivatives mountain poised to slide. The term systemic risk has gained traction, but what we face tomorrow is systemic failure. A moment when the mathematical models employed by every major bank on Wall Street will cease to function because they never accounted for a zero liquidity environment. This isn't merely about stocks declining, it's about the mechanisms of money itself fracturing. Before we delve into the specific triggers set to ignite at the opening bell, remember that knowledge is your strongest ally. We are entering a phase where price discovery will morph into price destruction. Our forensic team has been scrutinizing euro-dollar futures, revealing an unprecedented inversion indicating a catastrophic global dollar shortage. When the world runs out of dollars, it doesn't merely stop buying stocks. It becomes incapable of servicing its debts, resulting in a cascade of defaults beginning in emerging markets and ultimately reaching the U.S. Treasury's doorstep. This Black Sunday marks the moment the dollar trap finally snaps shut, ensnaring every nation that has borrowed in greenbacks but earns in local currency. We must scrutinize the margin debt data, which has surged to a record $750 billion. However, this is merely the tip of the iceberg. When we factor in the shadow leverage utilized by hedge funds through total return swaps, the true leverage in the system exceeds $2 trillion. As the first 5% drop hits the indices, these swap agreements will trigger automatic liquidations. Thus, a 2% standard correction can escalate into a 20% collapse within mere hours. The computers are programmed to de-risk at any cost, and when human buyers disappear, chaos ensues. The Magnificent Seven tech giants have served as lifeboats for the entire market. But those lifeboats are now overcrowded and beginning to sink. Nvidia's price-to-sales ratio has escalated to levels that historically precede a 90% drawdown in every tech cycle over the past 50 years. When the hype surrounding AI collides with the harsh reality of 2026, the revaluation will be violent. Our audit reveals that if these 7 stocks revert to their mean valuation, the S&P 500 could plummet to 3,200 overnight. Central banks have spent the last decade suppressing volatility, akin to forest rangers extinguishing every small fire. The result is a forest brimming with dead wood, awaiting a single spark. Black Sunday is that spark. By stifling minor corrections, the Federal Reserve has ensured that when the big one arrives, it will be an extinction-level event. The VIX index, which has been artificially low, is now displaying a coiled spring pattern suggesting a potential surge to 80 or higher, levels only experienced during the 2008 crash. The bond market, the adult table of finance, is currently sending danger signals. The term premium on the 10-year Treasury is finally turning positive, indicating that investors are demanding higher compensation for holding government debt. This marks the end of the bond bull market that has reigned for 40 years. When safe haven assets like treasuries begin to decline alongside risk assets like stocks, there will be no refuge left to seek. This correlation break is a hallmark of systemic collapse. As we analyze funds flow for this Sunday evening, our research indicates a massive capital flight from the European Union. With the ongoing energy crisis becoming a permanent fixture of the European economy, the euro is nearing parity with the dollar, not due to dollar strength, but rather European weakness. A potential sovereign default by a significant European player is the gray swan that could emerge before the New York market opens tomorrow. The banking sector is concealing a trillion-dollar hole within its held-to-maturity portfolios. Bonds purchased when interest rates were at 1%, but are now worth just 70 cents on the dollar. As long as banks refrain from selling these bonds, they need not mark their losses. However, if a liquidity event occurs tomorrow, as predicted, banks will be compelled to sell these bonds to meet withdrawal demands, transforming unrealized losses into outright failures. This scenario mirrors what transpired with the Silicon Valley Bank, but on a grand scale across the top 20 banking institutions. Our corporate credit analysis reveals dangerously low interest coverage ratios. Over 20% of the S&P 1500 are classified as zombie companies, meaning their profits fail to cover their interest obligations. They've merely survived by rolling over their debt at low rates. Tomorrow, as credit windows slam shut, companies that cannot refinance won't merely see their stock prices drop, they will plummet to zero. We are witnessing an unprecedented consumer credit crunch. The savings rate has hit an all-time low while buy now pay later